The 2008 financial crisis, often referred to as the Great Recession, stands as one of the most catastrophic economic events in modern history, affecting millions of people and reshaping the global economy in lasting ways. At its core, this crisis was driven by an unsustainable housing market boom in the United States. During the early 2000s, low interest rates, combined with lenient lending standards, made mortgages more accessible than ever before. This fueled a frenzy of home buying, and housing prices soared. Encouraged by rising prices, financial institutions saw an opportunity to maximize profits by granting high-risk home loans, known as subprime mortgages, to individuals with lower credit scores who typically wouldn't qualify for traditional loans. Many of these loans were structured with adjustable interest rates, meaning that borrowers would face rising monthly payments over time, something that, while manageable during an economic boom, would later prove devastating once the economy began to slow. Banks didn't stop at simply offering risky loans. They also bundled these subprime mortgages into complex financial products known as mortgage-backed securities (MBS). These MBS, along with other similar instruments like collateralized debt obligations (CDOs), were sold to investors around the world. Because they were diversified across thousands of loans, they were marketed as being relatively safe, with top credit rating agencies labeling them as high-quality investments. Yet, the problem was that as more and more high-risk loans were included in these securities, the quality of these investments began to deteriorate. However, because the financial products were so complex, even some of the world's most experienced investors and institutions didn't fully understand the risks involved. The allure of high returns led banks, hedge funds, pension funds, and individual investors to buy into these securities heavily, fueling an even greater demand for more loans, which in turn incentivized banks to lend even more irresponsibly. By the mid-2000s, this speculative bubble was growing dangerously. Banks and financial institutions engaged in what's known as leverage, borrowing heavily themselves to fund their activities. With borrowed money, they could multiply their potential profits, but at the cost of multiplying their potential losses. Some banks and hedge funds were leveraged by as much as 30-to-1, meaning that even a slight drop in asset prices could completely wipe out their equity. Prices continued to rise. Everyone from home buyers to bankers seemed confident that the good times would keep rolling. Few foresaw the consequences if the bubble were to burst. However, by 2006, cracks were beginning to show. Housing prices began to stagnate, and then, in 2007, they began to decline, leaving many homeowners with mortgages that were higher than the value of their homes. As prices dropped, a wave of foreclosures swept across the country. Homeowners with adjustable-rate mortgages found themselves unable to keep up with rising monthly payments, and those who had taken out interest-only loans or loans requiring little or no down payment were particularly vulnerable. As foreclosures increased, the value of mortgage-backed securities plummeted. Banks and investors who had heavily bought into these securities faced mounting losses, creating a ripple effect that spread quickly through the financial system. Lehman Brothers, one of the world's largest investment banks, was among the hardest hit, eventually declaring bankruptcy in September 2008. The collapse of Lehman Brothers sent shockwaves through the financial markets, marking the start of a full-blown financial panic as confidence in the stability of major banks and financial institutions evaporated. Following Lehman's collapse, other financial giants teetered on the brink. Insurance company AIG, which had issued vast amounts of credit default swaps, a form of insurance on risky securities, faced potential collapse as well, leading to a massive government bailout. As financial panic spread, banks and institutions across the globe realized the extent of their exposure to bad debt and became wary of lending to one another, resulting in a severe liquidity crisis. Businesses found it difficult to secure the financing needed to operate, and individuals faced a near freeze in credit availability. Stock markets around the world plunged, wiping out trillions of dollars in wealth. The economic impact went beyond Wall Street. As businesses struggled, unemployment skyrocketed. Millions of people lost their jobs, and those still employed saw wages stagnate or decline. As consumers spent less, businesses cut back, creating a downward economic spiral that would take years to reverse. The effects of the crisis spread globally, leading to a worldwide recession. Many countries experienced severe economic downturns as the demand for exports from the United States declined and financial institutions worldwide struggled with bad investments tied to the American mortgage market. Countries like Greece, Spain, and Ireland faced particularly severe debt crises, leading to austerity measures that impacted social services, pensions, and public sector employment. The global nature of the 2008 financial crisis revealed just how interconnected modern economies had become, with the struggles of one nation quickly impacting the economic stability of others. The shockwaves extended into everyday life as people around the world faced unemployment, lost savings, reduced pensions, and a loss of confidence in the institutions meant to safeguard their financial well-being. In response, the U.S. government and others around the world took unprecedented action. In the U.S., the government launched the Troubled Asset Relief Program (TARP), a $700 billion fund to bail out banks and prevent the collapse of the financial system. The Federal Reserve also slashed interest rates and began purchasing securities to inject liquidity into the economy. Internationally, central banks coordinated actions to stabilize financial markets. The crisis also spurred a wave of regulatory reform. In the United States, the Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted in 2010 to curb the kinds of risky behaviors that had led to the crisis. The act created the Consumer Financial Protection Bureau (CFPB) to protect consumers from predatory lending and established regulations on financial institutions designed to increase transparency and accountability. Additionally, Dodd-Frank included provisions to prevent excessive leverage by banks and required large financial institutions to create living wills to plan for an orderly shutdown in the event of bankruptcy, avoiding the kind of chaotic collapse seen with Lehman Brothers. The 2008 crisis left an indelible mark on financial practices and economic policy. Beyond the regulations, it influenced individual and institutional behavior, leading to a more cautious approach toward investing and lending. It also shifted public perceptions, with many questioning the fairness and resilience of a system that seemed to reward a few at the expense of many. Today, as we look back, the crisis serves as a profound lesson in the dangers of speculative bubbles, unchecked borrowing, and the importance of responsible oversight. For anyone navigating today's economy, it's a reminder of the risks inherent in financial systems and the value of informed, vigilant investing. Understanding the past can guide us toward a more stable, resilient future. Thanks for watching, and remember, the lessons of 2008 are as relevant today as ever.